Hey, Ren. Qu- question.
Hey, Bryce.
Question. Would you partake in this capital raising? The company was offering shares at a 55% discount to their closing price for the day.
Uh, yes, knowing no other information, yes.
Interesting. You would have just bought Webjet.
Okay. That's
So,
that's okay. For a 55% discount, I probably could have lived with it.
firstly, cheers, mate. I don't have a beer for our
Ah,
afternoon beer discussions. A bit
cheers.
underprepared for this one, but
I guess that's why we need a beer sponsor. Because
you're right,
Bryce
Ren.
clearly can't read the brief.
Yeah, I've clearly got enough Chardonnay, so we don't need a Chardonnay sponsor. But yes, still ready for the beer. Anyway, Ren, the reason I ask about this is because I want to chat about over a beer, obviously. Well, firstly, if you're new to the segment, this is afternoon beer discussions. The rules are simple: one beer or wine, one topic. First person to finish their beer has the right to hang up.
If you listen to the podcast, you're starting to understand why Bryce has a scripted intro.
I don't have a scripted intro. It is in my head.
Yeah.
um,
But yes, one beer, one topic. The topic today is capital raisings.
yes.
You've started with asking me a question about Webjet. Before we get into it, I'm going to ask you, I'm going to tell you, nice mo, bro.
Thanks, bro. I was like,
have you been,
I didn't realize.
have you been growing that for isolation?
This is the thing. Either my beard has become such a part of me that no one's realized. What I did was just shave my beard and left the mo, but I got on the work calls and everyone's gone.
People are realizing.
Everyone's gone, mate, you've grown that mo really quickly. I'm like, no, I've just shaved my beard.
Okay. Fair enough.
Trick of the trade. But
It's
anyway,
not
yes,
bad.
we digress. I want to chat about capital raisings because there's some pretty interesting stuff happening at the moment in the space. Triggered by what I was reading today about Webjet, and then went a little deeper. And Macquarie have also released a list of stocks that they think have been a good opportunity for investors who got, took up the offer of the capital raise. So I'll quiz you.
Which is a real rose-colored glasses way of looking at it. But I think
Definitely.
we'll get into that. We'll cover the basics of a capital raising quickly. But very rose-colored glasses way to say this is a good opportunity for existing investors, because many existing investors are probably thinking the exact opposite thing as these companies are raising at very low valuations.
Yes. So if you were to explain what a capital raise is to your housemate who's probably sitting right next to you now, what would you say?
So essentially, companies list on the share market to raise money. They want to raise capital to spend on their business operations. And then capital raising is basically they're doing the same thing again. They offer more shares of the business for more money from investors.
Nice. My question, if I was just starting out and hadn't come across this, would be, is it a good thing or a bad thing that a company is raising capital?
Well, yeah, neither good nor bad.
Nice.
I guess it really comes down to how they spend the money. If a company is raising money to buy a great business that's going to massively help their fortunes in the years ahead, massively increase their sales, massively increase their profit, and they get a good return on investment in terms of the price that they're paying for the business, then that's a great capital raising. But if the company is raising money for some other purpose, for some terrible acquisition that they have to sell in a couple of years, then not great.
So would it be a situation where a company would raise capital to stay afloat?
Well, yeah, right now it is.
Yeah. So that's kind of what's been happening with Webjet. As I started at the start here, they obviously...
Well, hold on. Before we get into the specifics, it's probably worth just explaining why, in general, for existing investors, capital raisings aren't, loved. So really simply, if you've got a company and it has 10 shares on issue, that means that every share is worth 10% of the business. If they need to go and raise however much money, and they say to raise that money, we'll issue another 10 shares, that means there's the existing 10 shares and then the new 10 shares. So there's now 20 shares of that business, meaning that every share is worth 5%. So if you're an investor in the original company before it raised money, as an owner of that business, you're entitled to 10% of its earnings. And, if it grew its profit, you got a 10% share of that. If it paid a dividend, you got 10% of the total dividend it paid. Now, all of a sudden, there's 20 shares, which means you've gone from owning 10% of the company to owning 5% of the company. So you get diluted as an owner is the terminology that you'll see. So for existing investors, they're faced with this choice. They either don't give their company more money, more of their own money, and then they own less of the company as a result because they didn't participate in the capital raising, or they are forced to give the company more money to maintain the share of ownership they have of the company. Like if I own, one share in that 10 share company and I want to keep 10% of it, I have to pony up. I have to front up more cash and give it to this company to maintain the percentage ownership that I had before.
Yeah, it's a tricky situation because, ideally the company is raising money to increase their return to shareholders over the longer term. As you said, maybe they need it for an acquisition, to buy more equipment, whatever it may be that, ideally will increase the return or earnings per share, return to shareholders over a period of time. But it's hard to know if their raise will be successful down the track. And I've had plenty of opportunities through some of the companies that I've invested in to participate in a capital raise, but I've never actually done it. Have you?
Yeah, the one that immediately springs to mind was my first investment, Slater and Gordon.
Why'd you do that?
I invested in the company at like, I don't know, $2 or $3 or something. And then it rose a bit, and then it did a capital raising because it wanted to buy an English. So I don't know if you can hear those birds.
Yeah, we can hear them.
So yeah, it wanted to do a capital raising to buy a British professional services firm, and it bought that company. It raised money at like $5 a share. And me being a new investor, participated in the capital raising, gave Slater and Gordon more of my money. And from there, that acquisition was a massive bust. They overpaid, and the company got done for a whole bunch of different things. And the share price plummeted to literally cents on the dollar. Like it was a nightmare, to the point where there was so little of my holdings left that I couldn't even cover the brokerage to sell. And that is the story of my first capital raising and my first investment.
Lesson learned. No, interesting. Actually, I do recall that the only capital raising I've been involved in was through one of the listed investment companies that I owned, and they were raising to have more money, essentially to play around with. But again, to your point, dilutes the ownership of the company. So yeah, it's a conundrum that investors face. But in a time like this, Ren, where we're seeing a huge amount of capital raisings come to the market compared to your average trading period, there are some opportunities out there, as Macquarie says, but a lot of companies coming to market essentially with hands out saying, shareholders, we need to raise money at the moment because our businesses have been shot. We need to pretty much stay afloat, or in some instances, we need your money to take advantage of the circumstances that we're in and perhaps buy some cheaper companies. So that brings me all the way back to Webjet, Ren, which were offering a 55% discount. So they went to the market and were looking at yeah, a raising that it's interesting. So they did a raise, which was 55% 55% below the closing price. So immediately, if you bought into them and sold, you could have made 55%. But from that point, the shares continued to drop 32%. So you were still above the $1.70 asking price for the raise. But look, you're only sort of above what you bought it in at.
Interesting thing, they never dropped below $2.
No, so they did the raise at $1.70. Yeah. And so if you'd bought it in as a shareholder, you've immediately made a capital gain on that.
Well, there's a timing issue there that you participate in the capital raising, but you only get the shares at a later date.
Yeah.
So, who knows, potentially when those shares get issued and people have them in their brokerage accounts, there may be a mass sell-off, and you'd expect the price to drop as a result. But yeah, it's interesting that at this point, it still is trading well above $2.
Now, I don't have a direct answer to this, but keen to hear your thoughts. But I would imagine that the reason they're offering such a discount is because they need the cash fast and they want to fill whatever the raise amount was. For example, I'm not sure what it was, say they were wanting to raise 30 million. They want to raise that 30 million quickly. And to do so, they offer such a discount so it becomes attractive to shareholders.
Yeah.
That would kind of be my thinking.
Yeah. I mean, there's probably a economic reason, a psychological reason, and we're not investment bankers by any means, but to your point, the lower the price, the quicker the book will get filled. And so from an economic point of view, potentially they just want to fill it quickly. And they would also be looking at, speaking to big institutions, figuring out what people are willing to pay, all of that stuff, and they would have priced it accordingly. So that's probably the economic reason. The psychological reason as well, like, could you imagine if Webjet, already in trouble, already getting smashed by the coronavirus, couldn't fill their book in a capital raising?
Yeah.
And the headlines were, Webjet trying to raise $30 million can only raise 10 or something. And the headline probably would have been written better than that, but it probably would have been more like, troubled Webjet fails in capital raising.
Yeah.
And
Steer
so
clear.
From a psychological perspective, as investors and as institutions, you see this company's getting hit by the coronavirus. Now it can't even raise capital from its investors. And that psychologically potentially creates more concern. So maybe they priced it lower than they needed to for that reason as well.
So Ren, I've got a couple of examples here of some companies that have raised at pretty decent discounts, but and are now trading above the ask price. And these, as I said, are companies that Macquarie have earmarked as being, I guess, a good opportunity because they believe that the company is going to be able to achieve a higher rate of return on the invested capital, especially given that, the debt that they might be holding is at a very low interest rate at the moment. So what they're doing with the money, and I haven't gone into that detail given the time, but what they're doing with their money, Macquarie earmark as being able to achieve great return on invested capital.
It's interesting that you say that before we get into the list, that debt is cheap. So really, to get money, there's two options. You raise capital, as we've been speaking about, or you get debt, and debt is extremely cheap. And so from a cost of capital perspective, it would seem to be cheaper to raise debt. And so, who knows the decision-making process for a lot of these companies, but it is an interesting choice. If you could get 1% interest from the bank, or you had to dilute all your existing shareholders and then, pay dividends on those shares for the remainder of time until you bought them back. It's an interesting decision. Yeah.
Don't the investing gods say that debt in the form of equity is easy to get but expensive over the long run? Debt in the form of a bank is hard to get but cheaper over the long run. The investing gods.
I've never heard that before, but
well,
I like it.
Well, I think I have. I think I'll coin that.
We had an Instagram post today of one of the quotes from one of our episodes. Someone posted it and tagged us in it. I'm gonna say that quote is not gonna get Instagram as well.
You never know, Ren. You never know. Now,
all right, let's get to your list.
Yeah, given that you need to get to Rebel Sport before it closes, I've just got a couple here. So there's NextDC, which is a data center operator. They raised at $7.80 a share, and they're currently trading at $8.52. Megaport, which again is to do with offering bandwidth solutions for private and public companies. They raised at $9.50, but are currently trading at $12.13. So a reasonable discount there. Then there's a pharmaceutical company that raised at $1.32, 23% discount, currently trading at $1.86. And then finally, Infomedia, which are a leader in parts and services for the auto industry. They were raising $70 million at $1.50 per share, and they're currently trading at $1.64. So a few examples there. Not huge discounts on all of them, but it depends, I guess, how they trade over the next little while. And yeah, I think it's just an interesting concept to get your head around. And if you're an investor that has an opportunity like this, give it some thought, I guess. Do you have any on your list?
I mean, look, the big one that people probably have heard about in the news is NAB. NAB are raising $3.5 billion for their capital raise. There was talk that Westpac might need to do the same, but it looks like at this stage that they don't need to. They're just going to wear the impairment costs, which I guess Westpac investors are probably pretty happy with. Cube, Monash IVF, Charter Hall. There's a bunch of companies that are looking to raise capital. Yeah, it's an interesting one. I mean, when you talk about those companies issuing more stock at such a steep discount, the thing that, you know, like in one sense, as an investor, you're like, this is a great opportunity if I like the company to increase my holdings. The flip side is, as an existing investor, you could look at that and be like, but the fact that they're pricing their shares so low means that they need to issue more shares to raise the amount of capital they need. So, you know, you could be already frustrated by the capital raising, then you could be frustrated by the amount of capital they need. Because, you know, if you need $100 million and you're raising at $1 a share, you're issuing 100 million new shares. But if you need that 100 million and you're issuing at $2 a share, you only are creating 50 million new shares. Mm-hmm. So, yeah, it's an interesting one.
So you're saying the bigger the discount, the more diluted the current shareholders will become.
Exactly. Yeah. So it's interesting.
Yeah.
I mean, look, the last thing we should say as I finish my beer is, if you love the discounts, unfortunately, you have to be an existing shareholder to participate.
Yes.
As you know, as someone that doesn't own NAB, I can't participate in NAB's capital raising.
Yeah. Which is irritating in some instances, but it's just one of those things, I guess. So, yeah.
That's all right. Probably not going to own NAB anytime soon.
Nice. Well, Ren, you finished your beer, so I guess we'll leave it there. Always good to chat. And if you are new to Equity Mates, come over and join us at equitymates.com on our main podcast, Equity Mates Investing Podcast, and also Get Started Investing. So you're not new, Ren. I know that. I wasn't talking to you just then, obviously.
Always finish on a strong note, mate. That's what they say. Always finish strong. Leave them wanting more.
Well, on that note, we'll talk next week.
Yeah.